Hello, everyone. This is Jeff Foley with Paladin Financial, and thank you for tuning in to this week's episode of Paladin Financial Talk. We've got a great show today. I'm sitting in the chair of our normal co-host, Mr. Tony Schwer, who is out of the office here today, so I kind of like this over here, all these buttons and things. I won't make any fun noises, but we have a special guest with me here today, Joe Norlin. Joe is a CPA, Certified Public Accountant. Welcome to the show, Joe.
Thank you so much for having me.
Yes. I think this is your first time, isn't it?
This is my first time here with you, yeah.
Yeah. We've known each other for a long time, done a lot of tax stuff together. And
Correct.
Joe prepares our taxes each year, so I very much look forward to that meeting with you.
Me too.
Every year. We're due here pretty soon.
Yes.
So, we're going to talk today about taxes, and our last episode that I was on anyway, a couple weeks ago, we talked about estate planning and estate taxes a little bit. So there'll be a little bit of crossover, some of the topics there with estate taxes. But we talk a lot on the show and work with our clients. We talk about a three-piece pie. So we have the holidays behind us right now, and a lot of pie was consumed, at least in the Foley household. So I talk about a three-piece pie. You have your financial plan, you have your estate plan, and you have your taxes. And we want to make sure that those three pieces are working well together and it's integrated and thought through, and those are not walking in three different directions. So taxes and estate planning, dovetail very well. And we look at assets, and everything that we do from an asset perspective has a tax implication, whether it's now or somewhere down the road. So if you're talking with someone, Joe, and you should contribute to your IRA or Roth IRA, that has a tax implication this year, but also down the road. So, we're going to talk a little bit about that. And it's not just about the money when we talk about transferring things to heirs, let's say kids to keep it simple, but could be someone else. It's not just about the money, is it?
Correct.
There's a lot more moving parts that go into that. What we don't want to do is hand people, a friend of mine, Jane, she uses the analogy of you've got the ball of Christmas tree lights that you wind back up at the end of the season. You don't want to hand that over to someone and it's a big mess. We want to have that organized. We want to avoid probate, something we talked about on the last show, and make sure things are pretty smooth. So the taxes have a big place in that as well. Talk a little bit about gifting, Joe, because that's something that comes out a lot in transferring wealth and their gifting limits. How does all that stuff work?
So first off, I like the pie analogy.
Are you a fan of pie?
I am a fan of pie. And
Okay.
in fact, some of the Paladin pies I received in the past are very tasty. So thank you for those. But it takes me back a little bit back in my career when I was doing public accounting, and I would have peers who would work with our clients, and they were so tax focused that everything revolved around tax, and the answers to everything were tax based. And as much as that was an important piece, from my perspective, it was always listening to the client and hearing them, and there was so much more to it than just what the correct tax answer was.
Yeah. It
was important from my perspective as a tax advisor with them to make sure they understood tax ramifications, but that didn't necessarily mean that that was what we were going to do because of so many other things and like the different pieces of the pie. So even outside of the financial and the estate and the tax, there was a personal feel to it as well.
Yeah.
They might have felt like doing something was the right thing to do, even though it might not have given them the best tax answer.
That's a great point.
And I found that clients appreciated the fact that I wasn't just trying to steamroll them with tax.
Yep. Yeah. It's I like to tell people, don't let the tax tail wag the dog, so to speak.
Correct.
Taxes are important, but it's
That's right.
not everything. Yeah, agree. So gifting, how does that work? You have limits that come into play with gifting assets to people, and what should people be aware of with that?
So from a gifting perspective, the gift tax and the estate tax are intertwined, but from a gift perspective, a person can give up to $18,000 worth of value to a person in 2024. And I say in 2024 because in 2025 it will be a different number. Mm-hmm. The IRS will adjust that from an inflation perspective. I think 2023 was like 17.5, but 2024 would be 18,000, and that's per person. And the significance of that number is I can give $18,000 to as many people as I want to. without incurring any gift tax reporting responsibilities.
Mm-hmm.
As soon as I go over $18,000 to one person, then I will have to file a gift tax return. So let's say I give $20,000 to two people, so I've given $40,000 total.
Mm-hmm.
Because I went over 18, that will require me to file a gift tax return.
Okay, got it.
And I'll report a gift that will net to $2,000 for each person.
Mm-hmm.
The netting is important because, well, let me ask this. Do you think then, Jeff, that will require a tax payment, or will I incur a tax liability because of that?
It depends on what type of tax. Yeah, but yeah, you have gift taxes. You've got to pay on that $2,000.
So the answer to that would be that, in theory, you likely wouldn't, because if you haven't then exceeded your lifetime exclusion, it would just reduce that.
Yeah.
So, not to make this a long, convoluted answer, but they play together. That's where I said when I started talking how they're intertwined. So the $18,000 is the amount that determines whether or not I have to file a gift return.
Mm-hmm.
If I'm required to file a gift return during the course of completing that form, it will determine whether I've incurred a liability or not.
Yep.
And for many people, the lifetime exclusion in 2024 is about $13.6 million.
Yep.
So that $2,000 in my example will just eat into that 13.6. And so when if that was the only gift I've made in my lifetime that's required me to file a return, I'm just going to eat into that 13.6, and ultimately I wouldn't have a tax liability.
Yeah. So you could pay that gift tax and not have, if you want to preserve more of that lifetime
That's a great point.
exemption.
It would be a nice way to capture the lower gift tax rate, because I'm not giving millions at that point. I was just giving a few $1,000s. So it would be at a lower rate that, as I think graduates up to the 40%.
Yeah.
So it would be a lower tax liability if I chose to pay that.
And that $13 million we have today, that goes away in a couple years, and we don't know exactly what that will be, but roughly half or so of the current amounts, unless something...
Obviously, so much of that plays into who's running things politically.
Yeah.
It's just the reality. And so right now, the way the law is written is it goes back in 2026 to, I think, roughly 5.5 to 6 million, because that would be inflation adjusted as well.
Yep.
So I've read different things where it'll be about 5.5 to 6 million. So that's an important step in, if I'm gifting, do I do it now to capture the 13.6? Am I going to wait? Do I anticipate a certain party being in charge where the 13.6 might be extended? There's so much that goes into that, and that's why it's important. You mentioned the word organized. Part of being organized is having an understanding and a plan with someone to make sure that you're capturing as much of the exclusion as you can.
Yep. And everyone's situation is different, and so many moving parts that can go into that.
Absolutely.
What about the type of assets that people gift? So you have, IRA and Roth IRA money that you can't really gift that to someone else. If you pull that money out of the account, you can't put it from your IRA into your kid's IRA. You'd have to cash that out. So generally that's not the best idea perhaps. But what about after-tax funds, and how does that work? When might that come into play as far as a gifting plan?
Sure. So I look at it in terms of like the best types of gifts to give, the types of gifts not to give, or prioritizing all of those.
Fruitcake is not one of those, is it?
Or pie.
Pie.
The pie was a good gift, so I have it on my list as the best gifts. It's the Paladin pie. But that puts me over the lifetime because it's so valuable. No, in all seriousness, cash is always a good gift. It's basic. We know the value. An important consideration also is basis in all of this. So depending on what type of asset I give, if I'm giving a non-cash asset, it's going to have a carryover basis. And the importance there is if we're talking about a gift tax or even an estate tax upon an inheritance, eventually there's might be an income tax component to this too, which would come into play when the donee ultimately sells or gets rid of the gift they received. That's down the road a little bit. So cash is a clear, clean gift. Appreciating assets are good gifts to give, from the sense of looking at it in terms of your exclusion. If I give a gift, let's say it's stock, and today it's worth $250,000, a year from now
I accept your gift, Joe. Accept your gift. I accept it.
Yeah. It'll be downstairs when we're done here. But let's say in a year from now it's worth $500,000 now. So that's a positive for the recipient. The reality is there's going to be a tax associated with that for them when they ultimately sell, but that's better than the value going down.
Yep.
But as a donor, you've given a gift that only counted for $250,000 against your exclusion, but now it's worth $500,000.
Yep.
So it appreciated. So appreciated assets are better. The other thing to keep in mind with that is, in terms of better gifts to give, and this gets a little bit more technical, and we can get into it too, but assets that help preserve other tax benefits. And so what I mean by that is, if someone, I'll say, is fortunate enough to incur a gift tax liability or a estate tax liability, and I say that because if they've exceeded the lifetime exclusion, kudos to them because they've done well.
Yep.
The tax piece is going to be there. It's just a reality you have to deal with. But the tax benefit that I'm referring to is, in some ways, there's deferral options in terms of paying the estate tax. So specifically, Internal Revenue Code 6166 is an election that allows for a deferral of 14 years and approximately 9 months to make the estate tax payments, which also, over that period of time, clearly there'd be an interest component. But what that does is it preserves, it keeps let's say if it's a business that was received, there's not a liquidity issue that could come into play if having to pay an estate tax immediately.
Wouldn't be a good thing. Yeah.
Correct.
Okay.
It might force someone to sell. Let's do an example where, let's say my parents give me a business, or I inherit a business from them, and there's an estate tax due with that. If the estate doesn't have a way to pay it, you might have to divest the business, which you maybe don't want to do. This preserves that, and there's some specific rules that go into play with that. Specifically, that closely held business needs to be greater than 35% of your total estate value.
Okay.
So it's a way to keep that in your hands.
Yeah, that's good. That's that's a good example too of how this ties into the pie and all the pieces working together. Is if you have an inheritance, you have estate taxes that need to be paid, it's hard to sell 25 or 40% of a business quickly to pay those estate taxes. So making
Correct.
sure you're planning ahead if you have an issue like that you have enough liquid assets that
That's
you
right.
can tap into in good and bad markets to be able to cover that. And it is a bummer Tony missed today because Section 6166 is his favorite part of the code. So,
Yes,
I'll make sure he watches this.
He recites
episode.
that to me when I see him come in the building sometimes, so I understand that, yeah.
What about some people that we meet with? Sometimes people will say, I want to gift my house to the kids. Why, from a tax perspective, might that not be as good of an idea versus passing the house to the kids after you're gone?
So, to me, the answer to that clearly relates to the basis aspect of it again. So we mentioned basis before. A gift receipt or a recipient of a gift is going to take a carryover basis in a asset.
Mm-hmm.
If I receive a a gift or an inheritance, if I receive an asset upon death, the basis step-up rules come into play and allow me to now have a basis in that asset. That's the fair market value at the date of death of the, I'll call it the donor or the decedent. So let's say my parents have a house that's worth $500,000, and they paid for it 30 years ago. They bought it for $50,000, and they have a $450,000 gain on it, and they decide to gift it to me, and they want to see that because they're still alive and they get a big smile on their face.
Yeah.
They've given me a nice value home, but they've also passed it to me with a $50,000 basis.
Yep.
Alternatively, in your question, if they're to wait till they pass away and now I inherit that home, I have a basis in it of $500,000. The importance of that is if I don't intend to use that home, or if I don't want to keep it for something, I'm going to turn around and sell it. If I sell it after receiving it on their death, most likely I would not have a tax gain on, or an income tax gain on that.
Yeah.
If they gifted it to me and I sold it, I would have approximately, in our example, a $450,000 gain. So it's an important difference.
That is a big difference. So, and that's tough too. Sometimes people want to gift to their kids or their grandkids while they're alive, and oftentimes that's when people need it more earlier in life versus getting towards retirement or into retirement.
The other interesting thing with that question, and I don't hear this a lot, but if they want to do it during their life and they want to basically see the smile, and if they know that the recipient doesn't have any intention to live there, it might be a better strategy for them to sell the home. Hopefully they have met the rules that are in place for excluding gain on sale of a personal residence.
Yep.
So then they wouldn't incur the gain, because if we go back to that example I gave, if that's a $500,000 home today and it has a $50,000 basis, if they're able to exclude any of that gain, they could still give you the proceeds, still see the smile on your face. I'd have a smile on my face if my mom gave me $500,000.
Yeah.
So they would still get that joy, but they wouldn't leave you with a tax bill.
Yeah. Good. So planning how all this comes together, the emotional aspect, but the financial aspect as well. There's different ways to approach that.
Correct.
Switching gears, for most people, they're tax-deferred assets, so their IRAs, 401ks, different types of retirement plans at work are their biggest assets, and some people have moved money over time into Roth or tax-free assets. That's the most common thing that comes up, is if people are wanting to earmark some of those assets for a kid, for example, or a grandkid. You want to look at tax differential, the tax arbitrage, if you will. If mom and dad are paying taxes here and the kids are in their prime earning years when they inherit that money and they're paying
That's a good point.
taxes here, you inherit an IRA or a Roth IRA, you've got to pay that out over a 10-year period of time. So that would be something where if you're planning to give those assets away eventually, it might make more sense to convert those more aggressively into Roth.
Correct.
Would you agree with that?
Correct. I would agree.
And they still have that 10-year clock. They have to liquidate the account, but they're liquidating it at no tax cost at that point. So that's something you want to plan ahead for.
Can I mention one other thing, too? We were talking about best gifts to give and not to give. In the not to gift section, clearly you can just take the inverse of the best ones to give, right? So we talked about appreciating assets are good assets to give. Obviously, then a declining asset is probably not the best asset to give.
Yep.
But I wanted to bring the not to gift assets up because there's some other important ones where, let's say it's a business interest that someone's thinking about gifting to someone else. An important factor to consider is there's certain things you could do that your intentions are good, but you could step on the tax classifications that you have. And where I'm going with that is, let's say you and I, Jeff, are 50% apiece owners in an S corp. and I decide to give my 50% to, let's say I have 120 relatives that all want to get a piece of the pie. Bring up pie again. So now you're an S Corp owner with 120 other people. The problem with that is there's limitations on the number of shareholders in an S Corp, which is 100.
Okay.
So now my gift has blown our S election, and we are now a C Corp. We're paying double tax,
Yep.
and which was not the intent of how we structured this entity when we set it up. So might be a stretch of an example,
Yeah.
but I think it could happen more easily than maybe we think. And to me, it's all about the organization again and knowing how are we doing this? Is
Yeah.
this the right thing to do?
And even if that doesn't apply to anyone that's listening, there's so many nuances to the tax
Correct.
code, and so many, and we've talked about a number of those over the years, of so many, not necessarily loopholes, but things to be aware of that could work in your favor or work against you, depending on. So,
And on that point, even we mentioned Tony's favorite section, 6166, and I'm surprised he hasn't called in and brought this up while we're on here, but it might not always be the best thing either. So if we've enacted that and we're happy because we're deferring our estate tax payments, does that do anything else from a business perspective? One of the examples I think of is in terms of creditors. Would creditors look at us as a business and say, oh, you're riskier now because you have this big tax liability? So it sounds great, but it's just another example of having to think of all the factors and utilizing assistance from someone.
Yep. That's good. Good. Yeah, a lot of different things to be aware of. And I almost forgot we were going to cover this at the beginning, but Joe and I, both big fans of dad jokes and our exchange. I have no tax-related dad jokes, but
I don't know if we've ever touched on that in the dad joke text.
No, we haven't. So, we'll have to. Let's see, share one with you. I had a meeting with a couple here recently, and they were having a discussion about their kitchen remodel, and they kept coming up with counter arguments, and just went on and on.
I love it.
I need
That's
to work
great.
on that delivery on that one, but
That's great. Well, I was thinking of one too where I was trying to think of one to share, but I've been a little distracted. We've been watching my sister's dog the last week or so, and it ate all the Scrabble pieces. We had Scrabble out playing it over the holidays, and it ate all the tiles. Thankfully, we brought it to the vet, but we have not gotten a word yet.
Oh, gosh. We might get some replies that we could have left the dad jokes off today. But I like that. That's
Thank
good. You. We have tax season now that we're in January here. Tax season coming up, and part of your daily to-dos and is doing taxes, Joe. And any words of advice, words of wisdom that you have for people in getting ready for this tax season?
Absolutely. I think I always go back to organized. I like how you use that term as we got started here in terms of estate and gift planning, that kind of thing, but it also applies with income taxes. What do I mean by that? Books and records. Do you have things put together? Can I give an income statement and a balance sheet to my tax preparer? Do I have all supporting documents ready? That's to help us from a prep and compliance perspective. What can we do from a tax liability perspective? Few things, I'd be making sure that we're taking advantage of all the deductions we can. They're put in place to be utilized. It's not about there's tax evasion and tax avoidance. Tax evasion gets you in trouble. Tax avoidance is smart. I like to think of that as proper planning and not paying more than we're required to.
One involves an orange jumpsuit and one doesn't?
Correct. That's correct. In addition to public accounting, I had a number of years working with the IRS, and they're testing for compliance.
Could have left that out, Joe. Could have left that.
It was a valuable learning experience. living on that side of the table for a while.
Yeah.
But the reality is they're testing for compliance. They're not necessarily looking to make sure they've gotten every single dollar out of you that they can. So what I mean by that is they'll go in and they'll look at a handful of areas, and if those areas are up to snuff in their eyes, they're moving on to the next thing. They're not going to sit and typically go, line by line and make sure everything's square. So if you're organized and you have support for things, that's the best way to operate.
Mm-hmm.
But then in terms of a tax liability, taking advantage, like I said, of all the deductions you can, taxpayer-friendly things like bonus depreciation.
Mm-hmm.
Am I planning to buy any assets that would qualify for bonus depreciation? Well, is it better to do it in December than January? Obviously, there's a cash flow analysis to that too.
Yep.
But just as the gift exclusions, lifetime exclusion is going to adjust, they're also adjusting bonus as we work through the next few years. And the amount of bonus depreciation is dropping 20% per year.
Mm-hmm.
So I think in 2024, it's going to be at 60%
Okay.
immediate write-off of an asset. So if you know that and you're going to buy something in December of 24, it's probably better to buy it then than it is in January of 25, because then it goes down to 40%. So that's a taxpayer-friendly thing you want to take advantage of.
Yep.
The other one from a calendar perspective that, I like to look at things that, what can we do after the year's passed? Usually that's when people ask. They should be asking you during the year, what can we be doing? But oftentimes the retirement options allow you to go up to tax filing day. So do I want to contribute more to my retirement? Have I put in as much as I can? It's better to give yourself money than the government.
Yep.
I would think everyone would agree with that, hopefully.
Yep.
Trade-off there is it's not dollar for dollar. It's you're gaining a deduction. So you're reducing tax liability by that tax rate.
Yep. That's good. Couple things that come to mind for me too is just like in healthcare, if you have a doctor and you see your doctor, you have to be an advocate for your health and be proactive, ask good questions, think about things. Don't, as I like to say, show up on your tax preparer's doorstep and throw them a shoebox with the requested documents and run the other way. Is be proactive and think about some of these things is an important one. And also one of the things I do that kind of worked out over time is have a list of the prior year's deductions that I've used. And when I gather everything to meet with you for the new year, is I go through last year's deductions to make sure I brought everything over and I have that for the new tax year. Right. That saves you a little bit of time and make sure you don't miss something.
Correct.
So, yeah, those are some great ideas. And, thank you very much, Joe, for joining us here today. And again, folks, if you haven't yet, please give us an honest review. We'd appreciate it on whatever podcast app you're listening to. Take a moment and let us know what you think about the show. Give us a great rating. We'd really appreciate that. It makes it easier for other people to get exposed to the show, not opposed to the show. But thank you for joining us again, Paladin Financial Talk. If you have any questions, you want to come in and meet with us and get a complimentary second opinion on your pie and how all those pieces work together, give us a call at 651-842-8406. You can also visit us online at paladinfinancial.com or email us at info@paladinfinancial.com. And we always welcome, for our regular listeners, if you have any questions that you want us to cover on the show, feel free to give us a call or send us an email with those. We'll be glad to cover those in one of our upcoming episodes. And have a great week. Again, thank you very much.